This has moved up, Jeffrey, your recession timeline, it sounds like?
I think it has to, because this is one of the things that I use indicators that are, again, maybe I think I know something that I don't know because I'm using the past again. But I do think that one of the indicators that had not been signaling recession was the yield curve was getting steeper and steeper. And in all the past recessions, going back for decades, the yield curve starts de-inverting a few months before the recession comes. And so since we were at peak inversion last week, it was unlikely that we were going to go into a recession even in the next 4 to 6 months. But at this point, with the de-inversion happening, the 4 to 6 month time window is starting to seem much more plausible. I just think to save kind of the program and their credibility, they'll probably raise rates 25 basis points. I would think that would be the last.
Really?
The last increase, yes.
I'm surprised to hear you say that. I would think that, this has caused such an earthquake, or certainly some pretty serious tremors, that they might not do anything in March. But you actually think they still would go in the name of their own credibility?
I do. I do think so. We'll see what the inflation numbers come out this week. I mean, who knows if they're really that relevant in the context of this banking crisis. But I do think I think the Fed will raise rates 25. I do. I wouldn't do it myself. But what do you do in the context of all this messaging that has happened over the past 6 months? And then something happens that you think you've solved, or I think the administration thinks they've solved it. And although it's a sleight of hand, it's sort of a magic trick to accept bonds at par that are worth 70 cents on the dollar. But I think it has clearly calmed the waters. But the Fed, I think, will raise rates 25 basis points. It's just, I think in the market pricing, I think it's kind of a coin flip right now.
Wow, because I mean, you know, when you see what's happened with, let's say, the 2-year yield, which is, gosh, it was down 100 basis points over 3 or 4 sessions. You've always maintained the case that the Fed follows the 2-year. The suggestion that, Jeffrey, that the Fed chair left us with last week was higher, faster, for longer. It seems to be on the precipice right now, no?
Right. I mean, let me put it this way. It'll be proof positive that the Fed follows the 2-year if they don't raise interest rates. Proof positive. Because, as you just said correctly, Judge, 1 week ago, 1 short week ago, it was higher, longer, you know, more than before, and all this other stuff. And then a few days later, what they're going to go to no hike. Then they're simply, absolutely, positively, if the Fed doesn't raise rates next week, we should absolutely shutter the Fed and just use the 2-year, which I've been saying facetiously for quite some time. But at this point, it would just be blatantly obvious that they're following the 2-year if they don't raise rates.
In the Dodd-Frank financial protection bill, former congressman, is because of this Wall Street Journal article this evening, which alleges that Barney Frank has spent the past couple of years earning more than $2 million on the board of the now seized Signature Bank, pushing to weaken some of the very laws that he put into place. Joining us now in this developing story is the Wall Street Journal's Andrew Ackerman, who contributed to this piece. I mean, Andrew, everybody's kind of going back on Twitter because that's what people do. It's his fault. It's Trump. It's Biden. It's whatever team you're on, they just automatically blame the other side. This is the congressman whose name is on the legislation, retires, works for a bank, makes a couple $1 million. What exactly was he trying to change here?
I think he did testify in support of the regulatory rollback, but I think the argument he made was that the 50 billion figure, there's a threshold they had for what's called heightened prudential standards. So Dodd-Frank says, hey, if you're above 50 billion, you're going to be subject to all these new tougher rules. He just said, hey, that 50 billion, it's totally arbitrary. It could be higher.
Yeah, fair enough. And this is kind of where people are going back. They're going after the former president. But you got to admit, Andrew, it's a bad look. I mean, when it's not like he was a random congressman. It's the Dodd-Frank Consumer Financial Protection Bill.
Yeah, I mean, I think this whole episode has showed that the revolving door is very much on display. You've got Barney Frank on the board of one of the failed banks, Mary Miller, who was the senior Treasury official, also a Baltimore mayoral candidate. She's on the board of SVB. Obviously the head of SVB, Greg Becker, he was on the board of the San Francisco Fed, which looks totally asleep. We're not really sure what their examiners were doing. So you have people kind of in government going in a private sector, kind of like, or the opposite. The whole thing kind of looks a little rough.
Yeah, and by the way, you wonder what the San Francisco Fed was doing. I know what they weren't doing, which is talking to the chief risk officer, and I only know that for certain because they didn't have a chief risk officer. From April or May of last year to January of this year, Silicon Valley Bank did not have a CRO, a chief risk officer. I mean, that alone, do you think, and not like we knew, there's thousands of public companies, we can't track them all, but shouldn't that have been kind of a little bit of a flag to somebody? And
welcome to the Crypto Teacher. And I come back with that video just to make you think.
Don't forget to like and subscribe to the channel.
And guys, the Fed has so many moving pieces, I can't go over them. I'm going to put a lot of the articles in the Patreon, and a lot of the Patreon members are sending me information. But there are a lot of moving pieces going on. Of course, the banking is what they want us to see, but behind the scenes, they're moving towards their agenda. Now, we had Gunlack speak about the Fed raising rates. And it's funny, guys, remember, we have CPI numbers tomorrow, so we'll know whether they're going to raise rates anyway tomorrow. But Gunlack speaks about the Fed and their magic tricks. And guys, I go over yields with you on a daily basis. And like he stated, if you're looking at the 2 and the 10, you know exactly what the Fed is going to do. And we're not headed for a recession, guys. We're headed for a Great Depression. This is going to be some of the worst times in economic history. And I told you a long time ago that this was going to happen. And you have less than 24 months to decide whether you want to be on the right side of history. And remember, the Crypto Teacher told you.
Does more of the lending business in America go to the shadow banking system, some of which might be described, by the way, as the firm that you're the chairman of, which is Apollo?
Well, the term shadow banking is very funny. It's a pejorative term. The question is non-bank lending, and there are very different types of non-bank lending. One type of non-bank lending that is not as susceptible to duration risk is matched funding. The issue here is that these were demand deposits. You're funding your lending with short-term obligations that can be called at any time. One of the things that is happening in what you call the non-bank lending market is that you have matched funding, which in instances like this is much safer.
Hey, Jay, shadow banking just means unregulated. And that's the concern, that it can create problems that are systemic that we weren't watching. And that seems to be the case to a certain extent with what kicked off this time around, that SVB, that the Silicon Valley Bank, was not held to the same regulatory standards as bigger banks that are thought to be systemic. Unregulated banks, unregulated shadow banking institutions have even less regulation. And that's the concern, to not be able to have oversight into things that could be eventually putting U.S. taxpayers' money on the line.
Look, Becky, you're right to raise the issue. This is going to be debated as we do the post-mortem on this. What I will note is that this failure at Silicon Valley Bank was in an institution that was highly regulated, had examiners and the like, and still the issue of duration risk came to the fore here. We should be looking across all of the financial systems.
Argument around the Federal Reserve and Jay Powell. I've seen people this weekend say this is his fault, that he raised interest rates, did it too fast, and did it without regard for understanding the implications on these smaller banks. Do you think of it as his job to deal with this? Or do you think, and by the way, I think that it isn't his job to deal with it in that regard, but actually the truth is that the banks are supposed to know that, yep, it could rain, it's raining today, and that they have to build a bank that can withstand the rain?
I think Chair Powell has been one of the most transparent Fed chairs in history. He has clearly signaled where they've been going. This has been no surprise to anyone. And I think criticisms of this being the result of a very transparent interest rate policy, they have no measure with me.
Are the comparisons apt? And do you look at this and say it's over, it's finished, or there's more to come?
Look, I think, like always, there are valid comparisons and there are differences. I think the difference that we should talk about is that in 2008, we were talking about individual institutions as systemically important. I think what we're talking about here is the regional banking system writ large as systemically important. And what happened was you had what I would say is an isolated incident at a fairly idiosyncratic bank bring to the fore an issue, which was, what do we do about excess deposits?
Right.
Deposits above 250,000 in the event of a failure. And that caused people to question whether their excess deposits at very solvent institutions were something that they should adjust, causing a classic run.
Right. Jay, though, let me ask you this. You were a Republican member of the Trump administration. I assume you are against, broadly speaking, big government. This is big government. In fact, I could argue to you that today all of the banking business has just been de facto nationalized if, in fact, we are going to be guaranteeing deposits across the board. What do you think of that?
Look, Andrew, big government, small government, government is an immense part of all of our lives. Okay, so it really is about smart government. I mean, what is government 18, 20% of the economy? Our financial system is one of the most highly regulated businesses, industries in the world. Government is in the financial business every day. Now, on the look, what was done this weekend was what needed to be done in the moment. And when you're acting in the moment, you need to act broadly and powerfully. Is there a time, as both Rogers that you've had on said so well, is there a time now where we have to recalibrate? Do we raise the FDIC insurance limit, but not make it unlimited? Things like that, definitely ask questions. But it's really about government calibration. Right. And look, post-2008, let me make this point. Post-2008, we were really worried about asset quality, stress tests around asset quality. Let's all recognize that duration risk was something that was on the back burner until we had this rapid rise in rates. And now we're all going to deal with it. And again, what the Fed has done here with the guarantee facility is given the market an opportunity. I think that's their aim, to deal with this duration risk.
Okay,
and guys, we know what SVB did was all caused by the Fed. But when it came to the bank run, it was 100% orchestrated. You were watching nothing but a movie. And we know how the NWO moves as puppets in and out of politics, and then plus in and out of these different corporations. We've seen it time and time again. But guys, when you're looking at this banking situation, always remember the goal. It's the fourth industrial revolution. They want to destroy this legacy market, so therefore the machines can take over the economy and the sheep go inside the metaverse. So when you hear about guaranteeing all deposits, guys, think about the fourth industrial revolution. You have to break this old system in order to bring in a new one. Remember, all people have to lose trust in order to accept this no privacy system that they want to bring on. Telling you what, where, and when and how to buy, and you have 3 to 6 months to spend it, or poof, it's gone. And now we see the Fed bringing in Michael Barr, and where's Michael Barr from? That's right, Ripple. And think about what XRP, XLM, and others are going to be able to do that are going to affect cross-border payments. They're going to be freeing up trillions and trillions of dollars of liquidity. This new financial system is not even going to be real, guys. It's all going to be tokenized, and I'm not even going to talk about the supercomputers, the AI, the algorithms, the robots, and blockchain that's going to run this new financial system like a well-oiled machine. Remember, guys, the NWO are the master magicians. What we're going through, guys, is biblical. And you know I give you the truth, nothing but the truth. Yes, the truth hurts, but it sets you free. Get in the lab and prepare. Because remember, my people perish from the lack of knowledge. Not because it's not there, it's because they reject it. And we know the Most High is going to reject them. And remember, the crypto teacher told you, because he knows when it comes to the New World Order, it's all planned out. You have a wonderful day.
Look, I think this was a giant bailout. I'd been hoping that they'd been able to sell the assets in the customer bank of basis of the bank and not resort to essentially providing unlimited deposit insurance. The predicate of deposit insurance has always been about protecting the little guy and having sophisticated counterparties of banks bear some risk and have some market risk. So I was hoping for different news this morning.
So what do you think should have been done? I mean, in terms of protecting the little guy, people would argue, well, what about small businesses who have accounts over that cap?
Look, we're talking about a bank that had 97% uninsured deposits. We're talking whose biggest creditor seems to have been a $3 billion account with a cryptocurrency. And we're talking about a bank where all the insured depositors had already been taken care of. And so I think what we're doing here is risking a fundamental structural change to our regulatory system in a situation where you had a bank completely under the nose of the San Francisco Fed. Where was the supervision of this bank? People talk a lot about regulation and the rules. I'm asking the question about where were the supervisors as this bank quadrupled in size over a couple of years and blew up a giant unhedged interest rate risk tied to Fannie, Freddie, and U.S. Treasuries. How was this allowed to happen right under the nose of the San Francisco Fed?
Do you have any theories on that? And what about the piece of regulation, Dodd-Frank, that kind of enshrined the current financial system?
Yeah, look, Dodd-Frank regulates laws and rules. You can't regulate judgment. And I am completely bewildered and betwixt as to where the lack of regulatory judgment was and allowing this bank to pursue such an unusual funding model, entirely reliant on uninsured deposits, investing all of that money in low-yield mortgage-backed securities a year ago. It's like the Fed had no idea that interest rates were going to rise over the next year and allowing that to go unhedged. There's only so much you can legislate and regulate. It comes down to regulators doing their job. And in this case, I think the Federal Reserve failed to do its job.
At the end of the day, when you create a run on a bank, that's illegal. In most states, there are laws against it. Let's see some DAs come out and do something about it. Let's see the SEC deal with social media. Social media did not exist in 2007 and 8 the way it does today and the way they're creating these runs. This is illegal to create a run. And by the way, we can solve this by guaranteeing all of the deposits of all the banks for some period of time. We did the same thing during the financial crisis, and we came out of it just fine. And look, at the end of the day, it's not the taxpayers taking losses. It's the FDIC, which is funded.
Going to a different economy, and we're going to be learning more about that as we go. But clearly, we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign.
And so we'll import Chinese-based CBDC technology. So it's going to be CBDC in a box provided to you by the People's Bank of China.
Cryptoteacher and the New World Order book, plus the 3 Kids books. It's time to re-educate. Also, new to cryptos, Coinbase, Bitrue, Binance, Do not forget book links and crypto links are in the description. The stock channel, guys. Don't forget to go like, subscribe, spread everywhere. You have your Kobo, your chip stocks, your banking, your gaming. While everybody's sitting at home, get on stocks, the Seaver, the biotech stocks. And while everybody's at home wishing they were still getting that free money, what are they doing? Drinking and smoking weed. Don't forget about those stocks, and you have a wonderful day. The most powerful person in the world is the storyteller. The storyteller sets the vision, values, and agenda of an entire generation to come. Steve Jobs. And guys, you know I truly believe in this. When you look at the New World Order, they're the storytellers. And that's the reason why I wrote my New World Order book. But guys, now it's time to change the current generation. And I wrote 3 kids books. You know I love the Trinity because I understand the power that's in it. So I have 3 books. We have an opportunity to change the generation, to educate, not just me, but I want to show you that I take action on a daily basis. And I want you to take action on a daily basis. Whether it's your job, whether it's in your community, we have an opportunity right now to educate the masses. I posted this on my Twitter account. Please share, but this is a short clip of the 3 books. There's going to be a clothing line and action figures. Please get these books for your kids, nephews, cousins, friends, so therefore we can start the re-education now. Because as we see, the 4th Industrial Revolution foundation is definitely here. Robots, algorithms, drones, taking humanity out the picture. We have to re-educate. But let's get into the video.
Part 1. King Joshua and Grandma Tam save the village. Part 2. King Joshua and Grandma Tam save New York from COVID-33. Part 3. King Joshua and Grandma Tam goes to China.
It's mandatory to get part 1, part 2, and part 3 of this series. It's time to re-educate Generation Z.